Hi guys, my name is Chujina and my passenger number is 29409. And today I want to talk about a study on Dubai Islamic Bank in UAE, which is the credit risk and its determinants. For chapter 1, the issue that problems that faced by Dubai Islamic Bank is DIB confronted a serious unethical issue relating to fraud and so effects on DIB in the form of a loss of reputation and financial loss. And for the research objective, the first research objective is to identify the internal factor affecting the credit risk of the Dubai Islamic banks, and for the second research objective is about external factor, and for the third is internal and external. And for the research question, the first research question is there any relationship between the internal factors and the credit risk of Dubai Islamic Bank? And the second is about external factor, and the third research question is about internal and external factor and the credit risk of the Dubai Islamic Bank. For chapter 2 literature review, for credit risk arises when a borrower defaults on their obligation, leading to a potential financial losses for lenders. For banks, loans are the biggest way they deal with credit risk. And the formula for credit risk is by using non-performing loan divided by total loans. And for return on equity, research shows that the negative effect of credit risk on profitability can be measured most obviously by the bank's ROE. Different studies from various places has shown that higher credit risk measures like NPLs are tied to lower ROE. And the formula of ROE is by using net income divided by shareholders' equity. For internal factor that used in this assignment is credit risk, return on asset, return on equity, liquidity risk, loan loss provision, debt to total asset ratio, equity multiplier, risk-weighted asset to total assets ratio, leverage, and capital adequacy ratio. And for external factor, in this factor we use gross domestic product, inflation, interest rate, exchange rate, and yield curve. For Chapter 3 methodology, the sampling technique that we use is the data from Dubai Islamic Bank's annual report from 2014 until 2023, and the statistic technique we use is linear regression and multiple linear regression, and the research model is internal factor, external factor, and internal and external factor. For Chapter 4 finding analysis, for descriptive statistic, the mean value for return on asset (ROA) is approximately 0.0206, indicating that on average the company generates about 2.06% return on its total assets. The standard deviation of 0.0043 suggests that the ROA values across the 10 years period are relatively stable with low variability. On the other hand, the mean for GDP is around 3.02, showing that the average economic growth during the options period. However, the standard deviation is 3.65, which is relatively high, indicating substantial fluctuation in economic performance over the years. For correlation, 10 variables were found positive correlated with credit risk, while 6 variables were negative correlated with credit risk. The analysis shows that the LLP has a very strong and significant positive relationship with credit risk, where R equal to 0.852 and P is 0.001. This means that when credit risk increases, banks tend to set aside more provisions for potential loan losses. For ROE, which shows a positive and significant relationship where R equal to 0.670 and P equal to 0.017, indicating that higher returns may be associated with higher credit risk, possibly due to riskier lending strategies aiming for higher profits. On the other hand, loan and car are both strongly and significantly negative correlated with credit risk. For loan, the correlation is R equal to negative 0.710 and P is 0.011, meaning that the banks with more loans may experience lower credit risk, possible due to better credit screening or diversified lending. Similarly, CAR, which is capital adequacy ratio, has a correlation of negative 0.709 and P equal to 0.011, suggesting that banks with strong capital position are better protected against credit risk. In model summary, for model summary 1, which is internal, only 7 variables contributed to Islamic banks credit risk, which an adjusted R squared of 0.904 or 91%. In contrast, the remaining variables are not relevant to this study. For model summary 2, which is external, there are 4 variables contributed to Islamic banks credit risk with an R squared of 0.359 or 35.9%. In contrast, the remaining variables are not relevant to this study. For model summary 3, which is internet external, out of 16 variables, only 8 variables contributed to Dubai Islamic Bank's financial credit risk with an adjusted R square of 0.841 or 84.1%. In contrast, the remaining variables are not relevant to this study. For ANOVA, only model 1, which is internal, shows that the overall regression model that is significant with p-value of 0.073, while model 2 and 3 are not significant. For coefficient, the model 1 shows that ROA and IRP are significant to CR because of the p-value smaller than 0.10, since the p-value is 0.049 and 0.024, where it means that this independent variable have influence or impact on the dependent variable or credit risk. For model 2, which is external, it shows that all of these independent variables do not have any influence on the dependent variable or credit risk. For model 2, for model 3, internal and external, the result implies that just the independent elements need to be examined. None of these factors impacts CR, which is the dependent variable. In conclusion, when comparing the findings from the correlation and coefficient tables, it becomes that ROE and loan loss provision is the influential factors affecting the credit risk of Dubai Islamic Bank. And the recommendation that can deal with this problem is the first recommendation is Dubai Islamic Bank should strengthen its credit risk management by strengthening lending criteria and enhancing borrower screening. The growing of credit risk is indicated by an increasing loan loss provision where it left unchecked, and this will lead to reduced profitability. Next, the bank should to reassess lending concentration and tightening borrowing criteria for high-risk industry. Third, the loan quality can be raised by using predictive analysis and credit scoring models. Fourth, the asset recovery may be improved by reorganizing problematic loans and stepping up collection operations. And that's all from me. Thank you.